Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode 78, we're going to dive into some of the basics of the 0% long-term capital gain bracket and see how this applies on a high level to individuals and trusts. And we're going to look at ways that maybe you could leverage that 0% capital gain rate through trusts by borrowing each beneficiary's 0% long-term capital gain rate bucket. Now, as always, this presentation is not intended to substitute for legal or tax advice. Now, to start with, not many people recognize that there is a 0% long-term capital gain rate bracket that applies to individuals. Now, for 2021, this rate applies to taxable income, and I emphasize that term taxable income for reasons that we'll look at in a minute. But it has limits of taxable income up to $40,400 for individuals and $80,800 for joint filers. Beyond that, you have a 15% rate applying up to a higher bracket and then a 20% rate thereafter, plus potentially in the middle of that 15% bracket, a 3.8% Medicaid net investment income tax that kicks in as well. Now, it's important to note how this 0% rate works. It's applied only to net long-term capital gains in excess of your taxable ordinary income. So if you think of this as being a bucket that holds a limit of up to $40,400 or $80,800, it's good to think of this as being like oil and water. You'd first have to fill up that bucket with the heavier income, the income that's taxed at a higher rate. That would be things like ordinary income and net short-term capital gain. And those aren't taxed at 0%. They're taxed at their usual rates under the traditional income tax brackets. But if you have excess capacity in that bucket after filling it up with this oil of ordinary income and net short-term capital gain, that excess can be filled with long-term capital gain that can be taxed at a 0% rate. So the big question is, can this be leveraged through a trust? Now, for a trust itself, it also has a 0% rate bracket for net long-term capital gains, but that bucket is much smaller. That only applies up to $2,700 in retained income in a trust. So the question is, could you use the tax brackets of beneficiaries maybe to shift this taxation? Now, these are just ideas. These aren't widely used or applied across the board because they're complex, but there are two strategies where possibly you could leverage this 0% tax rate bracket of the beneficiaries. One would be distributing capital gains without allocating them to principal, or you could use the strategy of making the trust a grantor trust with respect to one or more beneficiaries. So what that means is that the right investment strategy, coupled with the right trust structure, could save income taxes down the road in some neat ways. Now, when it comes to distributions of capital gains, I can't do this subject justice in the short term that we have for this discussion, but when it comes to the income of a trust, usually a beneficiary of a trust is taxed on what's known as the distributable net income, or the D&I. Now, that's an income tax term, but it looks to more traditional accounting purposes to determine what that distributable net income might be. So usually the income of a trust that's taxed to a beneficiary will only include the more traditional incomes such as dividends and interests and rents and royalties. So the implication of that is that capital gains are usually taxed to the trust because they're allocated to principal. So if any capital gains are distributed to beneficiaries, they're still taxed to the trust and then treated as a distribution of principal, so the beneficiary doesn't include that long-term capital gain on their personal income tax return. However, the tax code recognizes that trustees are given the authority in many states to determine whether to allocate capital gains to income or principal under the Uniform Principal and Income Act or the revised Uniform Principal and Income Act. So potentially you could allocate capital gains to income, then distribute that to a beneficiary and have the beneficiary taxed on that income, which could use that beneficiary's 0% capital gain rate bracket. But there's some limitations to be aware of. One is that capital gains usually have to be equitably apportioned among the beneficiaries. So what that means is you can't go beneficiary by beneficiary and stuff their 0% brackets. So if you have a beneficiary who has already filled their 0% bucket and one who is not, you're still going to have to maybe distribute equally the capital gains to those two beneficiaries. So it wouldn't be a perfect outcome from a tax perspective. An important point to note as well is that you would also have to distribute the capital gain in order to accomplish this strategy, which kind of defeats the purpose of the trust, which is to accumulate capital gain in the trust and allow it to grow in a tax-deferred manner and in a manner which potentially avoids estate or generation skipping transfer taxes as well. Another important point to this is that this could defeat asset protection aspects of the trust if this income is distributed as well. You should also note that allocating capital gains to income doesn't really distinguish between short-term and long-term capital gains. So that means you're going to have to equally distribute your short-term and long-term capital gains according to state law in order to use this. So that would be another inefficiency from an income tax perspective as well. Another strategy we could look at is whether you could make the trust be a grantor trust with respect to one or more beneficiaries. Now, the ticket to entry here is that the trust cannot be treated as a grantor trust with respect to the actual grantor to be able to use this strategy. And if that's the case, then you can look at the beneficiaries, and under Code Section 678, if a beneficiary has the power to withdraw the corpus or principal of the trust, that beneficiary could be treated as the grantor of that trust with respect to the portion of the corpus they could withdraw. So the significance of that is that the beneficiary and not the trust would be taxed on that income, including potentially capital gains, without the need to distribute that income either. So, while the power to withdraw corpus is not ideal from an asset protection perspective, another neat thing that a lot of people don't realize is that if you have that 678 power, it doesn't have to be permanent. You could allow it to lapse or be released by a beneficiary, and then by doing so, the other grantor trust rules would kick in that would look at the beneficiary as if they were the actual grantor and examine whether that beneficiary retains the right to maybe receive income of the trust or have administrative powers over the trust. There's a whole range of other grantor trust rules that usually only apply to the grantor, but could also apply to the beneficiary if the beneficiary first holds a Code Section 678 power and allows it to lapse or be released. So, you could have a temporary right to withdraw corpus, such as a crummy right that extends to more than just the annual exclusion amount for gift tax purposes. And if that crummy right extended to a portion of the trust principal that generates long-term capital gain, and then that crummy right lapses, then the beneficiary's right maybe to receive income could still allow the trustee to treat that beneficiary as the owner for income tax purposes of that portion of the trust, which could leverage the beneficiary's 0% capital gain rate bucket. So the good news here is that that could be progressive, and it solves some of the inefficiencies we saw with the distribution strategy. And where this can be applied, it can be a progressive backdoor tax-free step up of the basis of the trust assets over time, because at the trust level, securities could be sold or liquidated and then reinvested at a 0% tax rate bracket with respect to beneficiaries who are quote-unquote grantors of the trust. But there are some limitations here. Even though you don't have to distribute the trust proceeds, for one, you may not be able to use this with minor beneficiaries because the kiddie tax rules would apply to keep them from having the same 0% tax rate bucket with respect to long-term capital gains that an adult beneficiary would. Another thing to note is that the release of that 678 power would still be a release of a general power of appointment for estate tax purposes, which would cause some or all of the trust to be included in that beneficiary's gross estate for estate tax purposes, and would force them to use some of their applicable credit, which isn't significant now, with the high 11.58 million exclusion, but could be significant if that goes down. It's also important to note that multiple trusts for the same beneficiary are aggregated for income tax purposes. So because of that, if the beneficiary was receiving ordinary income distributions from other trusts, those would fill up that bucket first before you could even look at their long-term capital gain through the Grantor Trust rules. So there'd have to be a concerted effort across all trusts for which that beneficiary has an interest in order to make sure that the income from those other trusts wouldn't affect negatively this income tax strategy. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.